Last week, we talked life insurance and taxes. This week, we're going to discuss what is the difference between minimum fund, overfund, and maximum funding high cash value life insurance policy. Those are three distinctly different terms, and there can be some confusion around it. This is the Life Insurance Financial Education Podcast, where we're pulling back the curtain on high cash value life insurance and how it can help you build wealth and achieve your financial goals. I'm your host, James Barber, your Oregon Cash Flow Pro.
And my name is Carlo Viqueira with NetWealth Finance.
So the reason for the topic of this was I was listening to a different podcast, one that I really like, and they mentioned overfunding and max funding and conflated the two and essentially said it's the same thing. And I definitely disagree with the assumption that that is the same thing. Help me out, Carlo. Why would we disagree with that?
Well, I think it's, you could technically say that max funding is overfunding, but the thing about it is max funding is very specific when we're talking about going up to the maximum that you are allowed to put into a policy based on the amount of death benefit that you have. And overfunding is basically anything that's above the minimum funding, really. If you're technically overfunding it when you're doing more than the minimum cost that is in that policy. So there's a big gap. There can be a very big gap between those two things.
Yeah, so it's kind of like every rectangle is a square, but not every square is a rectangle. It's the same situation. We have what's called a minimum fund amount, which is going to cover your cost of insurance. Let's use an IUL as an example. The minimum funding in the initial years will guarantee that you meet a no-lapse amount. You're putting in just enough so that they give you a no-lapse guarantee for a certain period of time. And then after that, you just have to put in enough to cover the expenses every single year. Now, that amount might be high. It might grow, especially as you get older. The amount that you have to put in there may go up. But you can just put the minimum amount. And so anything above that minimum amount would be considered an overfunding. And then you have there's two other terms really that we like to look at. One is, what's your scheduled premium? So like, what is the planned premium that you're planning to put in? And that planned premium may fit a minimum, any amount over that, an overfunded design, or it could even be the maximum amount that goes in there. But it doesn't have to be any of those specific terms, with the fourth option being that max funding. We're going to put up right to the penny what the government will allow.
Yes, and to connect that to whole life, it's a little bit simpler actually, because in whole life, because you have that guaranteed premium in that base whole life policy, that will not go up over time. And so that's where that minimum funding is. And then as we do things like blend in term, we can fit in more paid up additions, which allows us to get to that overfunding or max funding going up to that MEC limit. So a lot of it is very similar, but the main thing being in whole life, that minimum is a guaranteed amount.
Let's clarify it just a little bit more with regard to whole life. Just because I'm a stickler when it comes to language that we're using, the base amount of whole life always has to be paid. So that part is part of the minimum amount. But if we do add a blended design, you also have to pay for the term insurance. So add the cost of the term insurance to that minimum required amount, as well as a paid up additions rider. There's going to be a minimum cost of the paid up additions rider. So it's not just the base whole life that's a required minimum. It's a little bit higher than that. We're not talking large dollar amounts. Your paid up additions rider could be $100 to $250 a year. And then your term insurance, obviously that's just going to depend on how much term gets blended in, but that could be another few hundred to a few $1,000s.
Yeah, and some of those things can vary by product and carrier with regards to the term rules and how that will be. And to some degree, that can be priced in on certain products, what that amount is. And so there are elements of that, but yes, there is some variability, I think, that can come into play with those other factors. And with paid up additions, that is effectually the part that can end up going into that overfunding aspect. Like James said, there's that minimum amount, but you can go significantly more than that, especially if you're blending in a lot of term insurance.
Yeah, now here at the Life Insurance Financial Education Podcast, we always advocate for max funding a policy. If you own a high cash value policy, the most efficient use of it is going to be max funding it, which is different, as we've described, than a minimum fund and even just an overfund. That doesn't mean that those other ones can't necessarily work. You certainly have some flexibility where you could adjust whether you're funding it at a higher level or a lower level or the maximum level. In the IUL, there is some extra flexibility where you could not fund it at all in a given year, as long as there's already enough cash value in the policy to cover the expenses. That's kind of the basis of a universal life insurance design to begin with. It's a flexible premium product that doesn't have an ongoing requirement other than there's enough cash in the policy to cover the expenses.
In whole life, there is this requirement to make that base premium payment. And there are ways that we can mitigate for that if there's some kind of emergency, but you have to make that base premium payment. And, if you do run into a situation where you may not be able to pay anymore, there's options like using a premium offset, or another option is reduced paid up, which is effectively reducing to that minimum death benefit and to what you've already paid up for insurance units. The difference being whole life that has that premium that you're supposed to pay until that part is paid up.
Okay, so we've talked about the minimum fund, the overfund, and the max fund. Let's go a step further and get into what is the practical implications of funding it at any of those levels. Because people buy insurance for all different sorts of reasons. Most of the time, we deal with people who want to put a substantial amount of money into a policy. But I ran a few scenarios with one carrier at one age. I just did a 45-year-old male. And I thought, I want to go over the impact of the initial 7-year funding. What does it look like in 7 years? Where is our expense ratio on this policy in relation to the cash value that we've grown based on the projections that we're putting into this policy? Now, I always assume a 6% growth. I think it's a conservative amount. I think we can beat that number. But when we assume a 6% growth with this product, the numbers come out fairly interesting based on what we put into it.
Yeah, and I think that what would be helpful is right now we're going to talk through some of these numbers, but both James and I have some content on this, so you can get into the numbers and visual elements of it, and that could be helpful for understanding the differences here.
Yeah, I'm going to keep this simple because we're just doing an audio podcast here, but you can see actual numbers if you go to some of our videos on our YouTube channels, our individual channels, not this podcast channel. And you can find the links to those in the description. So be sure to check that out. Okay, if somebody gets a poorly designed policy, that means no term blend design, they've got the maximum commission charges. I used a death benefit of $1.1 million for a 45-year-old male. The minimum payment required on a poorly designed one, which means it's all base, this is an IUL, the minimum is $24,000 that you have to put in each year to meet that no lapse guarantee. Now, this is going to be a significant amount above the actual expenses. So this policy does survive as long as you keep making that minimum and it earns that 6% every single year that you own the policy. But by year 7, the amount of cash value you have in there compared to the expenses were about $7,000 for that year. The cash value in there was about $140,000. That's a 5% expense ratio just for that year. You have your $140,000. I'm not including any load fees. I took that out because the load fees go to zero if you don't put any cash in. So just the other expenses in the policy. By year 7, you're still at 5%. You started off quite a bit higher because this is a poorly designed policy. So the expenses are higher in general for almost the whole length of the policy. But 5%, still pretty significantly high by year 7, in my opinion. And you're about to find out why we don't advocate for a poorly designed policy. But you're also about to find out why we don't advocate for a minimum fund design.
Yeah, I think I want to stress that what James walked through there, we really don't recommend this kind of design for anybody. That is a lot of expense, and I think what he's going to jump into here really will lay out the stark contrast in doing a little bit of tweaks to how we design these things.
Yeah, and a bad design policy, you might see like 20% expenses in the first year, going down a little bit each year, but even still being at 5% by year 7, you're just taking such a big hit on the expense side that it's really inhibiting the growth potential in what would otherwise be a tremendous product. So with the optimized design, the expense in that first year may end up being closer to 10%. Now, what we expect in these types of policies is that you're going to keep putting money in each year, but the expenses are going to stay almost the same. They'll go up a little bit because the cost of insurance goes up a little bit every year as you get older, but it's not going to change by a whole lot. And if we're dumping a bunch of money in, we're really getting the advantage of owning a safe product that's protected from the downside, but we're getting a ton of money in it in relation to the expenses. So in the optimized design, we still have a $1.1 million death benefit. But because the expenses are so much lower, the minimum required is only $3,400 for the year. Now, if you only fund it at the $3,400, it'll survive for a long time. In this case, it doesn't project a lapse until age 85, I think. You're only putting $3,400 and not the $24,000 that we did in the bad design. So much lower commitment. But by year 7, our expense ratio is actually 13%. So a much higher expense ratio because we've been putting in such a low amount of money and that cost of insurance is still there every single year. It is really hard to grow your cash value when you have a very, very high expense ratio like that.
Yes, and I think that's the thing. So even by going with a design that minimizes the expenses in a policy, if you don't fund it beyond those expenses, you can see it still ends up in a situation where the expense ratio is higher because of that. So the minimum fund, also a bad call. So bad design, not great. Minimum fund, not great.
Okay, if we have the optimized design and we fund it at the same level as the minimum amount on a bad design, now we're putting in what is considered an overfunded amount. So we're putting in $24,000, but we did the better design that minimizes the expenses. It's the term blend. Difference here, by year 7, our expense ratio is going to be 1% instead of 13% just by funding it at that higher level. Or in the case of comparing it to the bad design, when we reduce those expenses, it's no longer a 5% expense. At year 7, it's only a 1% expense. We have quite a bit more cash value in that policy as well compared to the poor design.
Yeah, and that's the thing. So in talking through these, that first example being the funding level and matching that funding level with an optimized design, now you are really pumping in more cash beyond expenses, and that, in the end, cuts the expense ratio in that year 7 to 20% of what it was, which is going from 5% to 1%.
What we find is that no matter the growth, when we make the same growth assumptions, we can cut those expenses. It directly impacts the cash value that you're going to have in these policies. We can't control the growth. The indexes are going to do what they're going to do, but we can control the expenses. So vital to getting an optimized policy is to try and get those expenses down if you can. Now, in the optimized design, where we max fund it, this is where things get really good. In this case, our MEC limit is $74,000 a year. The minimum, remember, $3,400. So the flexibility in this product is you can put in a minimum of $3,400 or a maximum of $74,000 or anywhere in between. If you do put the max in there, we get that 6% growth. By year 7, our expense ratio is 0.3%. We are now rivaling the lowest cost index funds that you can find out there in the market that don't give you any downside protection. And if we push this out, my expectation after we get out 20 years in any of these policies, there's one expense cost in there that drops off, and that's the reimbursement of the cost to sell you the policy. That means commissions, the cost for underwriting, doing any of the medical exams or ordering medical records. That drops off. And when it's only the cost of insurance, you should see an expense ratio that's down around 0.1%. That's just awesome. It's an amazing financial tool if we have that downside protection at an expense that only requires us to surpass 0.1% to make money in any given year.
And the beauty of it, in this particular product, we also have the ability to use these indexing strategies that have a bonus that can completely cover that and still have some credit on years that are not so great when you have a 1% bonus. So that is the thing. If you max fund these policies, there's a lot of folks out there that talk about all of the risks of an IUL and all that stuff. But really, if you max fund a policy, it becomes pretty low risk, and certainly as compared to the market. When you can have a guaranteed 1% credit by using a particular strategy that is going to completely cover that 0.3 or 0.1 expense ratio in that policy.
So just to give you one more set of numbers, in that max funded policy where we're putting in $74,000 a year, by year 7, the cash value that's projected $638,000, and the expenses are a little over $2,000. I challenge you to find another financial product out there that will give you downside protection at such a low cost. I really don't think you're going to find it, at least not outside of an insurance product.
Yeah, and I think that's the beauty of using these life insurance products, having some understanding of it, and going for these optimized, max-funded designs. When you do all of those things, this can become the foundation for wealth that you really only dream of until you discover this. And that's why I really fell in love with this concept and the power of having that liquidity and having those protections is really powerful. But remember, getting one of these optimized designs and max funding it is really a key here. So it's good to explore, have some conversations with different agents, see some different illustrations. And if the numbers aren't really wowing you, I think that you might want to have a conversation with a different agent.
I recently put out a video on my channel about the importance of max funding your IUL. And a similar situation happens in whole life as well. It's just not a transparent product when it comes to seeing the expenses. So we mostly focused on the IUL in this instance because we can see what the projected expenses are in any given year. And it's easy to figure that as a percent. So in the video on my channel, you can see the actual numbers where I talk about the importance of max funding the IUL in order to bring that expense ratio down. The hurdle that we have to overcome in order to make money in the IUL is so low that it really becomes a low or no risk product at some point. That's not to say that there isn't risk or that there's not an opportunity cost. If you get a bad one or you happen to have some underperforming years in the indexes that you chose, that's the risk of any type of investment, really. But remember, we can control those expenses. So check out that video if you're interested in learning more about that, or reach out to one of us if you want to see some actual numbers or something that might fit inside your portfolio plan. Next week, we're going to talk about why paying cash might not always be the most efficient way to do your finances. What do we mean by that? Going to have something to do with infinite banking. With that, I'm James Barber, your Oregon cash flow pro, and I'm licensed for life insurance and annuities across the country.
And I'm Carlo Viqueira. You can find me at netwealthfinance.com or on YouTube at netwealthfinance, and we'll work with life insurance clients across the country as well.
Take care. See you next week.
Thanks for tuning in.
The next 20 seconds determine your future. Subscribe, meet with us, or continue educating yourself with these videos right over here.